seeing gains for a third straight day, settling above 37 a barrel. This comes after OPEC lowered the demand outlook for its exports while predicting oil prices will rise, get this, back to 70 bucks a barrel by 2020. So with the U.S. oil ban finally lifted and OPEC predicting oil prices to rise again over the next 5 years, what does this mean for U.S. oil producers and the overall energy economy? Joining me now is a guy you got to listen to. He's Stephen Schork. He's the sharpest mind on the oil markets out there. He's the editor of the Schork Report. Stephen, thanks for joining us today.
Great to be here.
So we've got mixed reads on this. We've got Goldman Sachs saying $20 a barrel. We've got OPEC saying 70. What do you think?
Well, the prediction from OPEC is, keep in mind, 5 months out. And the only reason why we've made long-term forecasting in commodities out there is to make astrology look respectable. So keep in mind, $70 barrel is still an attractive price. That translates still to sub-$3 gasoline at the pump. So that's not out of the question. The producer can make money at that level, and the consumer could go on and grow. But whether we get there, Liz, your guess is as good as OPEC's.
Yeah, that's a good point.
But with regard to lifting, absolutely. So with regard to lifting the ban, this is great news both for the energy sector in North America and for the consumer. This is because crude oil that we have now in surplus is a very light crude oil. It's crude oil that's very easy to manufacture into gasoline. The problem we have is that our refineries are engineered to maximize a different type of crude oil.
Right.
So in essence, what we would be doing is don't think about the U.S. exporting oil. Think about we are swapping out our high-quality, high-cost oil for low-cost, cheap oil to manufacture our to maximize our refineries.
Right. Stephen, here's the thing. Oil analysts have been saying that our fields, U.S. oil fields, some of them are almost tapped out. Some of them are in hyper-mature phase, that the reserves really aren't there. They're talking the Permian Basin in West Texas and New Mexico. Is that what you're seeing, too, that, you know, it's going to take oil prices to come up well above 35 or 40 bucks for that to be profitable, for them to do fracking to pull that oil out?
Oh, absolutely. Right now, oil prices are way too low for the majority of production here in the United States and Canada. So that said, we don't have to go back to $70 a barrel. I'm looking towards the end of this year that oil's back in that $45 to $55 range, which is still a very attractive price. But before we get there, we have to look at the fundamentals right now, Liz. The margins for refineries are fantastic. The refineries are making lots of money because they are putting in $35 crude oil and getting out $52 a barrel gasoline. So the margins are great. So what does that mean? Demand right now for crude oil is sky high. Demand for gasoline, sub-$2 gasoline, no snow, no ice on the majority of roadways in the United States. Demand for gasoline is through the roof. But what happens in February and March? The refineries go into their maintenance season.
Right.
We'll see demand destruction of 1 million barrels a day, and we're still producing over 9 million barrels a day. So clearly the fundamentals set the template for lower oil prices through the first half of this year.
Interesting stuff. Thank you, Stephen Schork, editor of the Schork Report. Merry Christmas
to you,
sir.
Thank you.